Hello, this is Mike Swanson, and I run the website WallStreetWindow.com, and odds are that you're watching this video because you got an email from me telling you that it's up, or the blog post is up and the video's in the blog post, because every single morning before the opening bell, I send out an email with the top stories I'm watching that day, and typically there's a link to my commentary on the markets. If you're not on that email list, click or go below the description in this video if you're watching on YouTube, and you'll find a link to sign up. Now, I'm doing this update on Sunday, August the 1st, to talk about what can we expect this month out of the financial markets. And in many ways, the stage has been set by what we've seen in the previous couple weeks in July. So if you can remember, we saw the stock market take a hit, let's say in the first half of July. It even had a day in which the Dow fell over 600 points, but then it bounced and rallied. That rally was led by several big cap technology stocks that heavily weight the S&P 500 and act as leader stocks. And those stocks are all reported earnings last week. So a lot of what happened when the rally started was people were buying these stocks, or traders and hedge funds, computer robots, institutional money. I'm not talking about small investors, but the big money players. They were buying these stocks ahead of earnings. And then all those stocks sold on the earnings news. I'm speaking of Amazon, Apple, Facebook, Google. Those are the five key ones. Microsoft also. PayPal did it too. And that can be a warning sign for the market. When you see the leader for the leader stocks and they sell off, that's a potential danger sign. But more significant was we also had seen the stock market internals decline. This means that more stocks have been going up than down really for 2 months now. And a lot of the fad stocks of last year that dominate the Robinhood most owned list all have been lagging for the most part since February. And it doesn't mean the stock market's going to crash, but it means that it's a step back time after the huge rally since April, or a breather situation, a drifting situation is what's set up. But this is kind of what I think we can expect for the markets now for the next several weeks. And there's also news factors that may help other things go up and other trades work. And we'll examine those in this video. But the other thing that happened last month, which is very significant, is a week ago on Wednesday, the Federal Reserve had a policy meeting. They released a Federal Reserve statement. And then Jerome Powell, the chairman, held a press conference afterwards. Now, they made no changes in the statement. That wasn't important. But it's something that Powell said after the press conference that's very significant. So several months ago, economists were expecting inflation to come. And there was talk that it did come, obviously. We've had CPI prints of 5%. Annualized was the last number, which is pretty big. And the Federal Reserve chairman several months ago was saying this is going to happen, this is going to come, and it did come. But he also was saying that this would be transitory. And he implied it would only last a few months and then go away, where now a few months have come and gone, and it's obvious it's not really going away. And the Federal Reserve historically would raise interest rates when there's inflation to stop it. And they don't want to do that because we have such a massive debt bubble. If rates were to go up, this would just, could cause the entire stock market to collapse. It could cause the bond market to also run into trouble. So what happened last week is he redefined the meaning of transitory from months to almost undefinable. In my last video, I actually play a clip of his remarks, so you could try to interpret it yourself. But basically, he now has no definition of transitory. So as a result, the odds of future interest rate hikes have been pushed out in the Fed Fund futures market. Just 6 weeks ago, there was expectations that the QE program could be pared back by the Federal Reserve starting in September. Now that's been pushed out too, till December or next year. So this caused the US dollar to weaken after the Fed meeting and gold to test 1825 on Thursday. And 1825 was the high last month. A break of 1825 will bring more buyers into gold. I believe what we've seen in gold was a stabilization trend, much like we saw in March. And then in April, we got the rally. So I think we're set up, but we need gold to break 1825 to bring those buyers in. Of course, the way to play a rally in anything is to focus on the best performing stocks in that sector. We saw that with my top stock pick of last month, and I plan on having another one out on Tuesday. I'm holding off on Monday because the markets in Canada are closed, and this is going to be a stock that is Canadian listed with a secondary listing in the United States and in some other countries too. So, but I'm waiting for the Canadian market to open on Tuesday, more liquidity. And so let's step back now and look at some charts and some of the news headlines to get a better understanding on the macro environment that we're now dealing with. And probably the biggest move that happened last month that took me, frankly, by surprise, by the extent of it, was the move in the bond market. This is the 10-year Treasury bond yield, and it has fallen down. It tested 1.20, 1.2%, and it appears to be heading down back below that level again. Now, I was expecting these yields to come down. Really, at the end of May, I was thinking, okay, these yields look like they're going to weaken. I'm a long-term, think interest rates will one day go up. But, you know, things get overbought, you get setbacks or temporary pullbacks in markets, and that's what we're getting in these bond yields. But it pulled back so much, I thought we'd get to 1.4, 1.3. We've gone beyond that it's got to make now it's making me and other people who follow these markets say, why? Why is the yield going down so much when CPI, annualized inflation, is 4 times the yield? Meaning we got negative yields in the United States, meaning if you buy bonds or CDs, you're losing money. You're guaranteed to lose money at the rate of inflation, value on the money that is. It's an awful investment, and it's happening. So why? Why is it happening? Well, it's part of a risk-off situation. Really, even though the S&P 500 made a new high, there has been some risk-off inside the stock market. That's why the internals have been fading now for 2 months. It's also why so many fad stock plays that did well last year are now not doing well. This is typified by the ARK ETF, which specializes in these type of stocks and is one of the most owned exchange-traded funds among small investors in Robinhood. Kathy Wood does a wonderful job of promoting herself on YouTube in the so-called alternative financial media, where she talks about promoting Tesla, new technologies, and hype, I believe. I believe she talks like some of the fund managers did in 1999 who were all invested in internet stocks. And the companies she is invested in have sky-high PEs. They make no sense when you try to value them based on their balance sheets as being good investments. So she talks about, you know, this technology hype, gibberish, I believe. But the more important thing is what the ETF is doing, and that is it's lagging the S&P 500. As you can see from the bottom, the ARK divided by SPY ETF, SP 500 ETF is lagging the SP 500. It's underperforming the market average. It's doing that substantially from February. It was red hot last year. Now it's a millstone. And you can see that it topped in February. It has not been able to make a new high, even though the S&P 500 briefly did that last week. So generally speaking, if you want to beat the market, you want to be in exchange traded funds, stocks, and sectors beating the market. The problem with lagging situations is when the market pulls back, they tend to fall even more to the downside. So they're become very risky. The CTF was a winner last year. Now it's very risky. And I'm not trying to pick on her or pick on the CTF. It's what's inside of it that's so critical, because all these Robinhood Top 100 stocks, that list is made up of many of the stocks inside the CTF. The same is the case with the newly launched Buzz ETF, which specializes in stocks that are the most mentioned on social media. It's basically a herd ETF. It owns what the herd is most interested in. It also is lagging the S&P 500. So there's pockets of risk and danger now in the stock market. And that's one reason money is flowing into bonds. It's not that bonds are a good investment, but relative to much of the stock market, they now are, because you may be guaranteed to lose money, relative worth of your money in bonds, but bonds are less volatile than many of the stocks inside the stock market, and will not decline if the stock market just falls 5% or 10% or 15%. Typically every year there is a minor pullback, and a minor pullback will smash so much of the popular stocks so many people own. Gold, though, can benefit if the safety trade move also pushes into precious metals. We saw that happen in 2018 when the S&P 500 fell 20%. Bonds, treasury bonds did okay, but gold really got a bid. Something like that could be set up to happen again. These are things I'm watching for in the month of August. But two things setting up a backdrop that is causing risk off is smart traders, hedge funds, institutional players. They buy ahead of news. And then people who don't really know what they're doing, they buy the headlines and get caught holding the bag. We saw that last week when the smart money, spent weeks bidding up earnings on these tech stocks, then sold the news. Well, the biggest news there has been is obviously the economic rebound from all the shutdowns last year. The economy went from 0 to, let's say, 70 on the speed pedal over the past half of this year, the first 6 months of this year. That's essentially what has happened. But now that speed pedal, the foot on that pedal is lifting up. So the huge speed momentum in the economy is now decelerating. That doesn't mean the economy is going into recession, or if this is a metaphor, is this is a car, it's going to hit a wall and explode and crash like a Tesla catching on fire. No, what it means is simply that the deceleration, the peak growth momentum has peaked, and that peak came last month, last quarter, and now, so that means the momentum of many companies when it comes to their growth, the peak momentum is over. That can hurt some companies, not all, but it can hurt some. Stocks heavily in debt, companies heavily in debt, and there are now stocks breaking down as a result. I'll point out one, Peloton, which is also an ARK Wonder stock. This stock has done nothing, and it looks like it's rolling over. It's right on its 50-day moving average, lagging the S&P 500 since January. Let's think of airlines. The Jets ETF invests in many airlines. If there's hardly any other industry in the United States as heavily indebted as the airline industry, and now it's trading way weaker than the stock market, even weaker than the ARK ETF. It bounced up. It fell below its 200-day moving average in July, bounced back up to it. That's the green line in the chart, and then rolled over last week, and it's been badly lagging since March. And other news is going to hurt it too, and that is the COVID situation. No one wants to talk about the COVID situation. I don't hardly ever talk about it myself, because if you do talk about it, people will get angry one way or the other. And frankly, people don't want to think about it. It's not fun to think about. I'm not saying, it's, well, I'll just say what I'm going to say. COVID cases in the United States made a low on June the 14th, and have been ticking up. And this is making national news, obviously, and controversies about what to do about it. I'm not going to get into all that. I'm just here to talk about what is happening and what it means for the stock market. I'm not trying to tell you how to live your life, but it's not a complete disaster, because according to the projections, the middle line is the current projection. Red is worst case scenario, not likely to happen. But the infections are growing. They have been growing, but that growth rate is also likely to peak out in 2 weeks. However, the infections are reaching a point above where they were in July and spring of last year, like halfway where they were at the peak around New Year's. So that's pretty substantial. The good news, though, if you want to think of it as good news, is that it is good news. Fewer people are going to die from COVID as they did in these previous waves. Why? Because better treatments, the vaccine, people vaccinated are less likely to really get seriously ill at all, and they're frankly not likely to die. It's just the way the statistics are. So, but this is causing some areas of the United States to, unfortunately, it's just, they're reinstituting the masks. So if you look at the news in Las Vegas, this is what the news is like if you live there. It's stories about the COVID. Someone's dead. They wish they would have got the vaccine. People are protesting too, against the mask mandates. And that's the big thing I want to talk about, is they've instituted mask mandates for the Strip, for people visiting Las Vegas and working in Las Vegas. And although the stories are most people are complying, there are many people who had been planning to go to Las Vegas who are now canceling their trips. So this is going to hurt the bottom line of the casino industry. And I like to look at Las Vegas as, just a place sort of to understand what does this mean for the rest of the economy? Well, it hurts the airline industry, for one, in tourism, and so forth. But the cases in Las Vegas are actually among the worst in the whole country. So you can see how the cases, although the good news is they're set to peak in just a week, they have risen way higher than I had any idea. So this is the thing. We kind of drown out wanting to look at this stuff. We hear about it over and over again. And I didn't realize what was going on myself until I looked this stuff up last week. But this is one reason the growth rate of the U.S. economy, the foot has come off the pedal, and it's causing institutions to look forward to the future. What are the implications? And they're looking now for U.S. economic growth to slow sharply next year. So we're peaking now, and it's just going to slow down from here. And really next year, they're looking at, these guys are predicting, like, I think it's around 3% GDP growth for 2022. So in a way, this is kind of like we're entering 2010. We had a giant meltdown in the economy in 2008 when real estate crashed, the stock market crashed, things rebounded in 2009, and then 2010, growth entered a way that, was fairly sluggish ever since, frankly. So that could be one reason why the Treasury bond yields are going down. But anyway, so to sum up, what are we looking for in the market in this month? We're looking at a market that has, when it comes to stock market and the bond market, more of a risk-off trend that really started over the past 3 weeks. And the selling of the big cap tech stocks last week is a warning sign. This doesn't mean the market cannot go up, but it means that the risks are now more to the downside than the upside for the next several weeks. Doesn't mean it's going to crash at all. I'm not saying that. I'm just saying, you know, the risks are to the downside. Everything takes a breather, you know, at some point. That risk off trade, though, can trickle into precious metals, and we could see a bid in there. So that's basically what I'm looking at for August, and we'll be talking with you later. Oh, if this is the first time you see me on YouTube, what you need to do is click the subscribe button and then click the bell next to it. That way, YouTube will send you a notification as soon as my next video is up, because you're going to want to get all my future video updates. And I'll be talking with you later.